Good morning, everybody. Welcome to our webinar on best practice integration, ensuring the marriage is as good as the courtship. This is the latest in our Selling Your Business series. It's great to see so many of you joining this morning and some familiar names. Hopefully this reflects the high level of interest in today's topic. And for many of you who are regulars, you'll continue to find our content useful. For those who aren't familiar with us, Moore Kingston Smith is a top 15 firm of accountants, tax and corporate finance advisors working with business clients across a vast range of commercial sectors, as well as not-for-profit clients and private individuals. In our West End office, we have a team of 8 partners and over 100 people specialising exclusively in working with the media and marketing services sector. Our media specialist corporate finance team primarily advises clients in mergers and acquisitions, in particular sell-side advisory, like taking sellers through the whole process, but also supporting sellers who have got a preferred bid. Strategic growth services, helping businesses get into shape in advance of a capital event, and financial due diligence, acting for a number of strategic trade inquirers and private equity houses in this space. Our corporate finance team led clients on in excess of 50 transactions last year, with around a third in the media and marketing services space. We work closely with our colleagues in the M&A tax team, providing, we think, a unique full-service M&A offering to our clients, all delivered by sector experts. We are also part of the more global international network, which consists of firms across over 100 different countries. We regularly team up with our colleagues around the world to assist on cross-border matters and to support clients with their international growth aspirations. In some of our recent webinars, we've explored what potential sellers should be considering when preparing their business for sale, highlighting the possible pitfalls and how to avoid them, and to ensure a smooth and successful sale process and achieve maximum value. In our webinar back in January, we focused on the buyer perspective, looking at the things acquirers focus on and the work they carry out when assessing the acquisition. And you can rewatch previous webinars via our website. So if you missed those and they sound interesting, please do go to our website and have a look. Today, however, we'll be looking at integration, exploring the steps acquirers take from an integration perspective to ensure that acquisitions will be a success, both before, during and after a transaction. And of course, experienced buyers know how important this is. We'll also discuss what sellers can do and what they should be finding out from potential acquirers, as well as how Moore Kingston Smith can help ensure the transaction's a success and deliver the best value for all concerned. So I am absolutely thrilled to be joined by Kathryn Herrick, who is the Interim Deputy CFO of Next 15 and General Board Advisor, and Tim Bonnet, who's the President of Unlimited Group. They'll join my colleague from Moore Kingston Smith, Dan Lehman, who's a corporate finance partner, for what I'm sure will be an incredibly insightful panel discussion as they offer their advice from what they've seen work well and also perhaps not quite so well from their wealth of transaction experience. So a little bit of background for those who don't know Kathryn and Tim. Hard to believe that there are any people out there who don't. Kathryn is recognised as a senior member of the UK media sector finance community. She has 27 years experience working with finance, commercial and operational functions of leading global marcoms, technology, retail and consultancy businesses. She also has 7 years holding board positions in an executive director capacity on main and advisory boards and audit and remuneration committees. Kathryn has recently been appointed as the Interim Deputy CFO at the highly acquisitive and indeed highly respected Next 15 Group, where her main responsibility is to integrate the recently acquired £100 million revenue engine group into the Next 15 culture and ways of working, so no small task. She has also taken on a non-executive plural career and is now supporting and advising a number of SMEs in the marcoms, digital retail, tech and SaaS-related space. So Kathryn's covered a load of areas. She's the integration queen, frankly, starting at Walkers and Smiths and PepsiCo and launching Red Cell, which was a multiple global integration in itself, to integrating Bates Cordiant into WPP, amongst many, many others. She has significant experience managing across all business functions, which has been particularly useful in terms of how she views and manages integrations. So I expect some wonderful pearls of wisdom from Kathryn based on her rich experience. We also, however, are lucky enough to have Tim Bonnet. Tim joined Creston PLC in 2012, and he was part of the team that took the 600 plus person strong network from a PLC to a private limited company, turning it from a group of agencies into an agency group under the Unlimited banner. And Unlimited has indeed gone from strength to strength. Tim leads the client relationships across Unlimited and has been growing its global partnerships with Service Plan and Hacker. He's helped a number of group acquisitions integrate into the business. Prior to Unlimited, Tim's held a variety of senior roles, both agency and client side, including positions at Shell Retail, where he launched Shell Smart, the first smart card-based loyalty program in the UK. He also worked at John Menzies, aiding the sale to WH Smiths, and with the Aer Lingus Group diversifying outside the airline. He spent 15 years at TBWA UK Group, where his responsibilities included CEO of Tequila London, CEO of Agency.com, and sitting on the TBWA UK Group Executive Board. So I'm very excited to have both Kathryn and Tim talking to us today. However, before we launch into the discussion, Paul Winterflood, who's a corporate finance partner at Moore-Kingston Smith, will be providing the latest M&A update covering activity from the first quarter of 2022 and sharing his predictions for what's to come for the rest of the year. Please do watch out for our full quarterly M&A report, which will be landing in your inboxes following the webinar, and which will go into fuller detail around the key subsectors of interest for investors and notable deals in the past quarter. But before I hand you over to Paul, I'd just like to cover a few housekeeping points. The webinar is being recorded and will be sent to you afterwards, so do feel free to share this with any colleagues who may find the content of interest. We're keen to have a lively conversation and would really encourage you to post any questions you have for our panel. Please use the Q&A function, because if they go into chat, I may just possibly miss them. And lastly, we're always keen to hear your thoughts for future topics and how you found today's webinar and ways we can improve our content. So we'd really appreciate it if you could just take 2 minutes to fill in on the feedback survey that will pop up in the chat box afterwards at the end of the webinar. So thank you very much for listening to the introduction, and I'm now going to hand over to Paul for the M&A update. Paul, over to you.
Thanks, Mandy, and good morning, everyone. Thanks, everyone, for joining, and great to see so many of you here again today. So first of all, I'm going to start with a review of the M&A activity in the media and marketing services sectors. I'll look at how 2022 has started, some of the trends, notable transactions before concluding with an outlook. Firstly, and very briefly, for those of you that haven't joined before, we track on a quarterly basis transactions in the media and marketing services sectors involving either a UK buyer or a UK seller, and we use that as the basis of the analysis here. So starting off with this chart, which analyzes the number of deals each quarter, and quarter one saw 111 deals recorded on our tracker, not quite at the highs of quarter three 2021, which was exceptionally high. 111 deals still is indicative of a very, very strong market. I think the first trend I'd wanted to touch on was the trend that we're hearing from acquirers, investors, and that we're seeing ourselves in both on the buy side and the sell side, and that's that deals on average are taking longer. And I think that is partly due to how busy the buy side advisors are in particular. It's quite difficult to get a due diligence assignment to commence immediately, and that's similar on the legal side as well. So we're finding that transactions are getting drawn out, and that is because of the amount of activity in M&A, not just in this sector, but in other verticals as well. So that may be driving a slight dip in the numbers, but that is absolutely not indicative of a weak market. I think the second insight that backs up that statement is that over the past three to six months or so, acquirers that we speak to on a regular basis have been feeding back at various points that they're going to struggle to assess up and coming opportunities until they have completed transactions that they're already working on. So there's clearly a bit of there's a number of factors which are all combining to mean that things are taking a bit longer. And in the sector where fit is absolutely everything, if you're a seller considering when to go to market, when we're advising them, we very much advise that if there's a certain acquirer who has a strong fit, taking into that, we take that market intelligence we're getting from those conversations to help advise exactly when to enter the market. So I think that's all providing comfort and confidence that there is still a lot of time left in this strong market. I think from quarter 3 2021 onwards, we very much saw a lift off in the number of completions, and that's due to a combination of factors. We've got the private equity houses continue to deploy capital, but I think particularly from quarter 3 last year onwards, trade buyers and particularly the bigger networks started to return to the market with rigor, and they're both two topics we'll explore. So firstly, in terms of the number of transactions, or the proportion of transactions that have private equity involvement, either directly, such as Mayfair Equity Partners who invested in LoopMe in this quarter, or indirectly, so that would be a bolt-on, what's known as a bolt-on deal. So for instance, IDHL, who were backed by Bridgepoint, and they bought an e-commerce and transformation specialist called Ampersand. I think the main insight from private equity, along with them sharing the view about transactions taking longer, is that their appetite and ability to invest in this sector is strong, and that very much points to a strong market. In terms of a couple of transactions to highlight, over the course of this webinar series, I know we've been tracking the progress of two B2B groups. The first, the marketing practice that got investments from Horizon Capital last year. They bought a couple of US-based agencies, 90 Octane and Campaign Stars, and Gravity, who received investments from Elysian Capital. They also made two investments in the US last quarter, in Ninth Wonder and also creative agency Morse Code. And both groups are ones we're tracking carefully. I think elsewhere, in terms of other capabilities, I think I'm expecting there'll be some significant transactions in the performance marketing and digital marketing sectors in the coming months. And given the investor sentiment, PE will continue to be a major driver of M&A. So this next slide, I think over the past few years, we've maybe focused a little bit less on the listed groups as a cohort of buyers, certainly in terms of the networks. As apart from S4 and Next 15, who have been acquisitive, their acquisition volumes have been in lower numbers. What this chart here tracks is the share performance since the start of 2019. And if you look at the right-hand side of the chart, going from top to bottom, and if you look at 2022, that's probably the clearest point you can see it. You've got S4 Capital in green, Next 15 in blue, the Moore Kingston Smith Marketing Services Index, which is a basket of listed groups, in orange, and then the performance of the FTSE in red. And I think the promising news here, and I'm sure it's reflective of your efforts over the past 18 months or so, is very much the divergence between the FTSE performance and the Marketing Services Index performance since 2021. S4 skews the axes a bit here, but you've got the average index, the index on a whole, being 50% up compared to the FTSE, which demonstrates the health of the sector, but also it starts to explain the uplift in deal numbers that we're seeing. In terms of the major network, Havas were the most acquisitive, making 5 buys across a variety of disciplines and geographies. The main one in the UK was Invika, a UK-based digital experience agency, and that was an 8-figure valuation. I think more broadly, the major network focus is more global. And I say, aside from cutting edge digital capabilities, it's unlikely that the networks are going to make regular investment in large numbers in the UK anymore. And this was very much reflected by none of the major holding companies acquiring anything in the UK in quarter one. One point that we raised in the last webinar was that influencer marketing is very much sought after as a capability, and that's started to come to pass. So WPP bought a US-based influencer marketing specialist called The Village, and I think we can expect a lot more transactions in that space over the coming years. Elsewhere, the two other groups were shown on the chart. So F4 Capital, they've made 12 acquisitions this year, only closing one deal so far in quarter one, which was a data analytics business. Clearly, there's been much publicized delay in their publication of their results, which led to the sharp share price reduction in March. But it's been over the whole period, it's been a bit of a roller coaster. But if you go from start to finish, that share price performance is still pretty strong. In terms of a less volatile, but yet still high performer, Next 15 have performed exceptionally well. And over the last 12 months, their share price has doubled. I think one point in there that they highlighted in their results was the amount of revenue growth, and they grew at 36%, including 26% organic growth, and that's pretty good for such an acquisitive group. And I think it demonstrates that their integration strategy, particularly around the previous acquisitions that they made, is working well. I'm sure Kathryn can share a lot more about what's the driving force behind that. And their acquisition that Mandy mentioned of Engine in this quarter was probably one of the major transactions of the quarter. Now just moving on to the analysis of the capability, and starting with marketing services, and in top spot in terms of the most sought after or the most common transaction type in this space involved data and analytics capabilities. Now, if I had £1 for every acquirer over the last 10 years who told me that they wanted to buy data and analytics capabilities, I'd be a very, very rich man. And until now, it hasn't really converted into transactions. And I think that's because the capability was very, very scarce. The skill set was very scarce, and bigger and organizations could just hire individuals, paying those individuals quite handsomely. I think now the capability is maturing, meaning that it's becoming, that businesses are becoming of a good enough size for there to be more consolidation, but it also is becoming more affordable skill set for those for acquirers in this space. So I expect to see digital data and analytics high up on this chart for many quarters to come. Another repeat high performer that we touched on is around performance and digital marketing, and those capabilities are extremely sought after quarter after quarter. Briefly looking at tech-enabled businesses in the sector, we analyze those between MARTECH, AdTech, and MediaTech, and MARTECH very much a sector to watch. Our research that we published at the end of last year shows the market size was $345 billion and growing, and that in turn is leading to plenty of transactions. So a recent market map produced by Chief MARTECH and MARTECH Tribe showed just under 10,000 solutions in the market, and that provides a lot of scope for consolidation over the coming years. And so it was MARTECH accounted for the majority of tech deals in this space, and I expect that proportion is only going to increase further over the quarters to come. Finally, in terms of the segments, just looking at entertainment, that's been one that we've historically seen a relatively lower number of transactions in, particularly compared to marketing services. However, from an investor perspective, it's certainly a sector they are watching pretty carefully, noting the headwinds the likes of Netflix are facing. Within this, gaming is very popular, and there's plenty of consolidation within the gaming sector, and that's driving a lot of transactions. Finally, just finishing on the outlook, and apologize for the slightly cliched picture, but on the left of the screen, clearly there's we're facing macroeconomic headwinds. The global political climate is far from ideal, and the likelihood of recession seems to be building. So it would be remiss of me to paint a completely rosy picture here. Clearly, these factors could all contribute to a tightening, which then in turn impacts on M&A, as uncertainty always does. However, there's blue sky on the right, and I think if anything that the roller coaster of the last 6 years has taught us is the level of resilience, both within the sector and then on a related point within the M&A market. The underlying trends of digital transformation, digitization, growing importance of first-party data, strategy and comms around things like purpose and ESG, all of this leads to transaction opportunities, which is good news. This is all backed up by new private equity houses coming into the market, looking to deploy capital, and that is a sure sign that investor sentiment, coupled with trade buyers continuing to look at acquisitions, means that our overall outlook, both the immediate future as well as the next few years, remains very positive. Finally, just to say, if anyone would like to discuss the market in more depth or to find out more of them, please feel free to reach out. Now, handing back to Mandy, who will chair the panel discussion.
Oh, thank you very much. Thank you very much. I think it's fair to say that there's always a market, a buyer for a great business. So if you've got a great business, there's always somebody who's going to want to own it as much as you do. But if we can now move on, Kathryn, Tim and Dan, to the discussion, that would be brilliant. Good to see the marketing services sector looking so strong. So let us, without further ado, because I want to make sure we have all the time we can for questions and so on and so forth, kick off with the first question. And please, just a reminder, if anybody watching would like to ask a question, please post it in the Q&A. But starting with a question for Kathryn and then Tim, what does good integration look like overall?
Thanks, Mandy, and morning all. So first of all, we want to try and cover integration in its broadest sense. So client, commercial, financial, strategy. So if we don't manage to touch any of those, please feel free to ping us questions throughout or at the end. So in my opinion, I mean, the process of integration should start well before you sign anything with anyone whatsoever at all, not when your deal is complete. So really good integration, in my point of view, is execution of a really mutually agreed integration plan, which, you know, should cover like broad areas such as timetable, when will it start, when will it finish, roles and responsibilities of buyer and seller, list of all the various tasks and activities and principles, and hopefully agreement on things like costs and investments and the famous topic of cross charges, which I'm sure we'll come on to later on. You know, typically these plans are split up by like work streams. Usually the buyer appoints a champion of this, and usually the seller appoints a champion, just to make sure the whole process, you know, keeps moving on. But it's really important to agree this, you know, ideally at heads of terms, and if not, between heads of terms and also at the SPA stage, and ideally attach the plan to your legal documentation to make sure it's there for everyone to see. So, you know, I also think like an integration plan should address and bring to life the key reasons of why you decided to join that buyer. So typically, for example, if you as a business wanted to focus more on top line revenue and growth, and you wanted to outsource or transfer your finance team to the buyer, then clearly you need to understand what that means, how are you going to be supported, what systems you're going to be using, how are you going to be cross-charged for that. So that also needs to be discussed in any sort of integration plan. Systems, the big one, you know, sometimes buyers insist that you go onto their financial systems and platforms, which obviously will have different charging structures to maybe what you're used to. But again, you'll want to know what that process is, because transferring systems can take a long time. You need to look at interfaces and how that impacts your current systems. You need to look at the impact of your finance team, etc., etc. But again, typically the bigger systems will cost more money, and you want to know how that can impact your earn-out or deferred payment mechanisms. And I think the other area is the whole onboarding process. With regards to financial reporting and in terms of what the buyer expects. I'll tell you a story of a bad example. When I was at one of the big groups and I was doing a major integration, I had to stand on stage the day after the acquisition was announced and basically describe to everybody the flash reporting, the month-end reporting, the forecast reporting, the budget reporting, all the templates, all the KPIs, etc. And I think the 50 finance people around the room nearly fell off their chairs, and promptly quite a few of them resigned afterwards. So that's a bad example. Don't talk about the reporting timetable after the transaction is announced. I mean, there are many other examples, but I'm going to hand over to Tim, and I'm sure he can add a little bit more colour.
Thanks, Kathryn. Yeah, well, interesting, actually, definitely a view from a CFO stroke COO's point of view there in terms of lots of process and orientation. I think from my point of view, it's I think taking your point about making sure that both parties understand why they went into this in the first place is really important. But that I see that more from, rather than a process point of view, more from a, are they looking to grow via acquiring new clients? Is it, or are they looking for the discipline skill set that this new business might actually bring in, and therefore how would that integration work? And whilst I recognise how important all those process things are, the thing that I think both parties should be looking for are two things. One is, first of all, making sure that both parties are wanting to maximise any earn-out, because if the earn-out has been maximised, it means that it's worked for both sides. Sometimes I see these things where there are barriers put in place to make sure that the second payment is as small as it can be, and that means that it hasn't worked for either side, and there'll be resentment. I think there's got to be a cultural fit, and I'm sure you've had, having not seen too many of these before, I'm sure you've had a lot of conversations about how fit is really important, and therefore, that's sort of making sure that you can get on, because I think if you can get on, you're more likely to get it to work. But also all those processes need to take away the burden of running your business, and allowing you to then go on and do what you went into the business in the first place for, which is actually sort of do good work and grow the business. I think in so many of these cases, sometimes that the business is almost killed by the processes that are put in place, and actually even during the acquisition time, there's so much time is spent with the management team that you've got to be really mindful that your business has still got to run during this process. So both parties need to be mindful of that and actually not ask for things that aren't going to be necessary on either side. But should we leave it at that for a second and go on for some?
Yeah, that's great. Thank you. I mean, it is interesting. I remember talking to one of our clients who'd sold to one of the multinational groups, who was saying that before, when he wanted to do something to do with HR, he just wandered to the end of the corridor and he talked to Angela. And now he had to send a memo to somebody in the US, who typically speaking took a week to get back to him, and it was just doing his head in. So I guess that's the kind of thing that you're saying, you don't want to make it harder, you want to make it better.
Yeah.
So Tim, moving on from that, what do you think, or what have you found can be the barriers to a successful integration, I suppose, from a seller's point of view?
Well, I'm sure Kathryn will talk quite a lot about earnouts and things like that, and I think if you don't structure things correctly, there will either be resistance from the seller to actually let anybody near their clients, because they'll feel that they're going to lose the revenue. It also, if you don't structure it right, the new management team won't want to get involved in any of the other integration work streams, because they'll feel it's going to again reduce their ability to actually grow their business. But I think one of the most important things to look at is if you think you're joining an organization and you're going to have access to a load of clients, you need to really look at that carefully. First of all, just because somebody's got a client doesn't mean that you're going to be, well, even if you're introduced, that you're going to get the work from it. You need to make sure that there are processes in place, and whether it's a methodology or some reason, so the client can see a benefit of this additional service or discipline being introduced, and how integration within that organization is going to be a benefit rather than using the existing agency they already use. I think the other thing that people sometimes misunderstand is that there are different buyers for different disciplines. And just because you've got a relationship with the CTO doesn't mean that you know the marketing director or the marketing director either. So I think sort of understanding that. I feel sometimes that the DD that is done is always done one way, which is the buyer is always doing DD on the seller. And I think sometimes the sellers ought to actually look a little bit more at things like the client relationships. How satisfied are the people, the existing employees, and all the things that the seller is asked to actually provide. I think it's sometimes maybe worthwhile for the actual seller to actually ask for some of that information back the other way, just so they can get a real understanding of what they're going into. Because inevitably, it tends to be senior management to senior management, and you don't get to see much of the organisation below that. I think it's really important that you understand what you're going into.
Yeah, that's a very good point. Kathryn, what do you reckon?
Yeah, I mean, the main barrier I've seen, and I've seen it so many times, is what can impact my deferred consideration, what can impact my earnout, what can impact me, how can I stay focused on maximising my earnout? And I think that is a big barrier to any sort of seller going into a group. And it all comes down to the definition of profit in your heads of terms or your SPA agreement. But yeah, so recharge is one big area. I mean, basically who pays for what and how does it impact my earnout? And this could be also covering areas of one-off costs, such as severance costs, etc., or onerous property costs, etc. Other exceptional costs could include like changes in accounting treatment. So I have had one recently where the IFRS standards changed and it impacted an earnout of a company, and the buyer said, sorry, that's the way it is, type thing. So these are things that you just got to look out for. Now, recharges can be done on a fixed percentage of revenue. That's typically what the big groups used to do, whether it's 5%, 6%, 7%, etc. But the trend now is much to make it more transparent, to do it item by item, which is painful because you've got to negotiate and agree allocation methods, etc. But at least it's more transparent than just one charge going through your P&L. So like typical areas like property costs. So it's great. A lot of companies move into a different building. That building may be more expensive than the current building that they're in. How's that charge sort of worked out? Usually it's on a per desk, and that includes rent rates, service charges, and facilities, and all those types of things. But in a post-COVID world, I mean, not everyone wants to come to an office and pay for the desk the whole time. So you've got the discussion about how do we get charged for property in a hybrid working environment. One of the ones I'm doing at the moment, we've got a client implant in the building, and there's a huge amount of people, but they're not there all the time. How do we charge that team for it, etc.? So the whole area of property is a big one, and it can impact an earnout because the numbers can be big. So other areas like audit fees. So typically the big groups, I'm talking about big groups here, will have a top 4 audit firm. And, we all know that they'll probably charge more than a smaller audit firm. And so how is that incremental cost treated in your earnout agreement? Back office support, what's covered? What services are we going to get? Is there some type of SLA agreement? We've all seen IT costs, go through the roof. How's that been treated in any earnout agreement? Treatment of exceptional items like restructuring. How are investments treated? All these things. And there's so many things to discuss. I just think this is an area which should start at any time, sort of post heads of term signing. and a buyer should list all these down in an itemized way and discuss them with you transparently and openly. And ideally you want an SLA agreement, you want intercompany agreements, etc., because you want protection as well.
Yeah. And undoubtedly it's it's the 9/10 of the iceberg you can't see in a transaction, and the completion of the transaction's just the tip of it that you can see. Dan, in your experience, what sort of concerns about barriers to integration do you come across?
Okay, I mean, and thankfully, it's hard to add to that. You've given a brilliant list, but I'd say the two that I'd add would be, first of all, control. So often, if a vendor is getting a significant amount of their money from a earn-out structure, and sometimes it can be well above half with growth factored in and delivery of that sort of plan, then they're going to want to often maintain control and negotiate hard for that control. Now, I can understand why that is, and we'd probably advise them to do so in a lot of cases. But what that can do is obviously damage the integration planning and the integration implementation. So getting the balance right on that and making sure both parties, before they start, understand exactly what they're agreeing to, I'd say is really important from a control point of view and authority, etc. The other thing I'd say is, and it's often not really thought about at the start of an earn-out, but succession planning. So, if an earn-out's for a 3-year period, let's say, towards the, halfway through that, people should be thinking about, well, what succession planning is there going to be if vendors want to leave after that earn-out? And a wise buyer would want to consider that risk. Now, obviously, succession planning involves costs, because if you're going to start hiring additional people and putting them in place to make sure that there is a succession plan there for departing vendors at the end of a earn-out, then thinking that at the very beginning and making sure you've not put a barrier in place in terms of a profit measure that doesn't have a add back for succession or something like that would be really wise as well, because otherwise the vendors aren't going to be encouraged to assist and recruit additional cost that's going to benefit the purchaser after the acquisition and after they've left, say after their earn-out, and isn't going to benefit them and just going to devalue their earn-out essentially. So I think that's one that's quite interesting to think through as well.
Yes, I think in general, structuring of earn-outs is both a science and an art, because it's finding a way that motivates everybody to do well, but also doesn't get in the way of 2 and 2 equal making more than 4 for the both buyer and seller, I guess.
I think I completely agree with you on that, Mandy, because we've always, I think pretty well all our acquisitions, we've had an earn-out structure sort of in it, but we've tried to kill it after the first year and actually pay it out, because in my experience, we found that actually it has been barriers to growth and integration on both sides, and it just gets people, it tends to be the thing that is, I suppose, the most fractious conversation in any relationship. And actually, if you can kill it off quickly and actually come to a mutually sort of agreement on how it's going to work going forward, it makes life so much easier for everybody, because you can do so much more. All those things that Dan has been talking about, looking at sharing resources, looking at succession planning, looking at proper integration across things, and not worrying about where the profit's going to go, but actually more about the top line growth of the revenue across the business. So as soon as you take away those earn-out sort of discussions, all that just falls into place so much quicker and so much more easily.
Yeah, and also I think, the whole areas of like resource sharing and pitch support. So for example, if another part of the business wants to borrow some of your talent to work on a client or to help on a pitch or to sort out an issue, how are you going to be compensated for that? Are you going to be compensated at all? Are you going to be compensated for their salary? Are you going to get a margin on that? Because obviously you might be taking away billable people to work on different businesses. And the other area is pitch support. Clearly you want your best team on pitches, but other parts of the business may want to take your talent as well. And then if you don't win the pitch, how does that work? So I think there's a lot of discussion around resource sharing, pitch support, support on client issues that also needs to be thought through in any sort of agreements that you have.
Yeah, no, I totally get that. And, you know, because when one thinks about some of the things that, you know, sellers are looking for from a buyer, it might be global expansion support, it might be referrals to clients, you know, the cost around that and how that's all allocated up and the time spent and how that affects the earnout, you know, is quite a key part, isn't it? Let me just encourage our listeners, our watchers to ask some questions. We haven't got any questions yet. But this is a unique opportunity to have these two incredibly experienced individuals in the room. So ask them absolutely anything you like. I have a gazillion other questions up my sleeve. So, you know, don't worry about there being an awkward silence. However, you know, this is your chance. So do please file some questions in. But moving on, I've got another question for you, Dan. Often when, and Tim and Kathryn have referred this, you know, resources will be provided by the buying group, which might help you save in terms of headcount, might as a seller, might help you save in terms of, you know, some of the costs by having some shared costs. And these are, you know, effectively integration gains. Will buyers pay the additional profit that they effectively provide?
I think the first thing to think about is that buyers will always consider the potential integration gains when they're doing their internal deal rationale and writing their board papers and before they justify their offer internally. So it has been thought about, right? So it's within their rationale. But I think we've got to go back a level, that in order for them to pay for them, they have to understand what is available. And so I'd start off by saying, if you want to get paid for those, which obviously everyone does, you know, you have to make sure that they're presented in such a way, you know, in your documents, your information memorandum and such like, that they're easy to grasp, but also that real time is spent with both parties talking about this. I think go back to what I think Kathryn first said, that you need a joint integration plan before any documents are done. I mean, we really encourage our sellers to spend time with the buyers, making sure they really understand the business and where those potential gains are, and also that the chemistry is right, so that, you know, you've got confidence they're going to be delivered. I think if you do those two things, you've got a much greater chance of then getting them to factor them into the offer that they then make. You know, typically, you know, buyers seem to be a lot more willing to pay for income synergies and additional income share than cost synergies, and that just seems to be a trend, that no matter how many deals you look at, that is a thing. But depending on how big those numbers are, I think it's perfectly reasonable for a seller to ask a buyer to pay for some of those cost synergies, especially if you can prove they're easily implemented and realized. Because one of the great cynicisms of a buyer is that you say all these cost savings are available, but how do we know we're really going to achieve them? So building the confidence for that, I think, is key as well. And the other thing is obviously a competitive process always helps in whatever way to get paid a lot more. You know, if there are a number of interested parties and your advisor is running a proper process, then, you know, it encourages people to be more generous with their offers if they know they're competing to win this crown jewel for their group. So that's also a thing. So I think those are the things that I'd focus on to try and make sure that integration gains are paid for. But happy if Tim or Kathryn have anything to add to that.
Yeah, I've seen more like buyers paying for revenue synergies than cost synergies, definitely, because revenue is growth, and they want to have growth, and so that's why they're prepared to pay for revenue.
Well, we've got a plethora of questions now. Thank you very much. Just a quick reminder, if you could possibly post the questions in the Q&A, not the chat. I have spotted the two that have gone in the chat, so we'll get to them, but sometimes I miss them as part of my cherry process. Tim, you've created a bit of excitement around the idea of concluding an earnout in the first year of sale. So we got one question which is saying, how common is it that the earnout is concluded in the first year after sale? And if we can skip round Tim, Kathryn and Dan to look at that. And then the second question on the same topic is, how do you finish the earn-out early? I assume you have to mutually agree the end number in advance. How easy is this? And that one's coming to Tim. But let's just talk about how common this is as a practice first. Tim.
Well, I think it's only common when things are going well, because I think it means that it's looking that the organisation is likely to hit there or thereabouts anyway. And as you rightly say, that you probably you'll have worked this out before you've actually done the transaction, because you'll have worked out in a typical transaction maybe 3 payments, one up front, one sort of after a year, one after say 3 years. And it's after the first year when you've actually said, okay, we're paying this one now. It's looking like, based on the current forecasts, and you've had an understanding of how secure the existing client base is, and you've also seen the benefit that that organisation can bring to other clients within the organisation or other parts of the business. And that's when you have the discussion, because you do go, look, we know that we could actually grow our entire business quicker if you weren't entirely focused on just growing your own bit, and therefore let's agree that you're going to hit X milestone, and we'll pay that out as long as you're still going to be here in 3 years' time. But let's take away that barrier, and now focus you on helping us grow the entire organisation rather than just your own division within. So I don't know how common it is across the industry. Kathryn, you probably have better knowledge of that, but it's certainly something that we've been trying to do, because I think that's how you get to have an agency group rather than a group of agencies. You really are then sort of working as one team, as Kathryn talked about before, demonstrating the value of a combined organisation to existing client, not worrying where the revenue is necessarily going to drop as long as you're increasing your revenue, and being able to do it in a much more integrated way.
Thanks, Kathryn.
Yeah, I think it's more common than actually people think. I've dealt with quite a few and dealing with one at the moment, actually. So I think it's on the extremes. If you're actually crashing through your earn-out, then you've got to renegotiate the caps and everything else. So that's quite common. I've seen it in quite a few occasions. Or when something's gone drastically wrong, like you've lost a major client and there's no way you're going to do your earn-out. So another way that you might want to collapse the earn-out is when things are going really, really well or really badly. If you're tracking someone in the middle, then you probably want to keep it going. So they're the instances I've seen most frequently. But at the end of the day, you just have to mutually agree that and decide what you want to come out of it. So as Tim said, if you want to just basically collapse it and then join another part of the group and focus on growth and work through that, but then you're going to have to replace it with something like a long-term plan or annual bonus scheme, or look at some KPIs, etc. So I think the collapsing is a discussion, but then you need to replace it with something. And typically I've seen 3-year LTIPs put in place, focus on revenue and margin improvement or revenue and profit growth. So I would say I would say 25% of transactions I've seen have actually been renegotiated.
Yeah. Dan, a quick word from you on that?
Yeah, I think very quickly, it really depends on whether the earn-out is working or not for both parties as to whether they're going to want to renegotiate. If it's working for both parties, they'll probably let it run. If it's causing obstacles for the purchaser, then they're going to want to try and negotiate. On the other hand, for the seller, if it isn't working for them either because they're well overperforming or well underperforming, as Kathryn said, they're going to want to. So I guess it really depends on each case. So I don't think I can give you an exact number, but the circumstances will dictate.
Okay, thank you. We will, by the way, for any questions we haven't got to, see if we can get back to you following with some generic answers. So I will press on, but I don't think we're going to quite have time to cover them all. There's a question here from Robin. Press releases for new deals often do a poor job of clearly expressing the shared proposition and why it's better, different, etc. Why is that, and what can companies do about that at an early stage? Kathryn, then Tim.
Sorry, Matt, I didn't actually hear all the questions. Sorry, do you mind repeating it?
Oh, beg your pardon. Hang on, sorry, I've lost it. Yeah, basically press releases for new deals often don't manage to capture the magic of what you think you're achieving. Why is that, and what can you do about it?
Yeah, okay. So press releases, obviously if it's a public company that's buying, there's obviously certain things that you have to put in a press release and certain things you can't put in a press release. So I think that is dictated very much by the governance structure. So that's probably that point. Also, I think some companies are quite secretive because they actually don't want to actually explain why they're doing the deal, and almost want to keep that secret sauce to themselves. So I would say, if you wanted to PR a deal, then you would do it, through sort of like network. You wouldn't necessarily put it in press, in my opinion, or you would talk about it through your annual report in terms of the rationale, etc. And also some of the rationale when you put a press release out is actually not fully thought through. So maybe it's too early to put it into a press release.
That's a good point. Tim, any thoughts?
Yeah, I mean, I have to say that sounds like somebody's just buying revenue rather than actually strategically understanding why they've gone into it. And it doesn't sound like a great reason in the first place. So either that the buyer hasn't got a clear proposition and USP of their own that they're saying this is going to enhance, and therefore demonstrating to their existing clients and also to the business that is joining that by having these two businesses come together, their proposition is going to be even greatly more enhanced by this. And so it does sound to me that if somebody's doing a press release which is purely talking about sort of two organizations coming together, it sounds like it's a revenue buy rather than a clearly thought through sort of reason why these two organizations are coming together. And it's back to what we were talking about at the beginning, which was what does good integration look like? And I think if you can't write a press release at the start of the thing of explaining why this is going to be your benefit, then you're probably with the wrong partner, to be honest.
Yes, that's very well said. I've got a question here, and I think this is one for Kathryn, which is about tracking the goodwill asset value. Possibly one for Kathryn, I don't know. Tim might want to volunteer. So when this company, when we buy companies, we typically look to absorb the trade into our existing business in the region, meaning we strip all of the value out of the purchase company. Do you have any tricks up your sleeve on how to navigate this without having to manually track in a manual P&L? I'm sensing there's a lot of manual frustration here. The residual value of the trade. You may not.
Oh, the whole topic of goodwill, yes. So obviously we know when you buy a company, you have to, there is goodwill at the end, and then you have to split that goodwill into different component parts and treat that goodwill separately. But to be honest, in my experience, all those goodwill type things have all been done at group consolidation level and haven't really bothered the businesses or anything with it, unless you're carrying losses and you want to push the losses down to the businesses and get them to utilize the losses. But I would probably say I would have to pass to my more technical colleagues on anything else. But yeah, I mean, it's typically a group consolidation adjustment. So
yeah, okay. So I think the answer Sorry, Tim.
The only thing I'd add to that is I completely understand why the guys from Jellyfish are saying that, because it does, if you're carrying too much goodwill, and particularly around the name and things like that, it does make sort of integration sort of from a financial point of view more challenging going forward, in terms of if you want to actually perhaps over a couple of years time, in 2-3 years time, want to merge the names into one, and so it becomes one business. You then got to deal with goodwill write-off and all the rest of it. And whilst it's not necessarily a sort of a profit thing, it does, particularly if you're a PLC, as Kathryn will remember on a number of occasions, it does give you some grief sometimes in terms of
definitely. Yeah. And my only other tip was like to make sure you get tax advice on these types of things as well, because you don't want to lose any tax benefit by doing certain things and triggering certain things. So if you move goodwill around, it might trigger a gain somewhere or a loss somewhere else. So I would say definitely get good tax advice.
Yeah, always. We are very nearly done. I want to round up with one final question. There are a couple of questions in here we haven't answered. And Tim, if you could manage like a kind of 2-sentence reply to the one about unlimited. They've got this is from Simon, they've got a very distinct culture. You've got a very distinct culture. How do you go about blending in with a new acquisition with your culture, for example, looking at hirings?
So I assume you mean hiring into
Into
the new organisation.
Mm.
Well, I mean, I think we work. I mean, particularly when we've done acquisitions, we've made sure that the culture, we have got similar cultures, and that actually, I've seen there's a couple of advisors like Simon there, and actually when we do the due diligence, part of what we're doing is actually looking at the culture that the organisation has as well. So we care as much about, not just about the relationship between the clients, but also the relationships with people sort of internally. And I think if you haven't got that open and willingness for the desire to grow the business on both sides with the people, and the mutual respect. And I suppose where we've come from is because we haven't had a legacy big advertising agency, and I'm not suggesting there's necessarily a different cultural fit in the big ad agency, but there is no clear defining lead partner necessarily in there. I think that we found that the people tend to have mutual respect for each other and actually welcome each other's discipline and understand the strength that can bring. And that sometimes doesn't always come the case when you join a large advertising group.
Yeah. Yes, no, absolutely. Okay, well, listen, I'm going to wrap it up here, but one final question to each of our panel, which is, if you had one top tip to a seller going into an organisation to try and get integration right, or to a buyer, I guess, what would it be? I'm going to go around my screen, clockwise, which means I'm going to start with Tim, then Kathryn, then Dan.
My one, I mean, actually, I think the press release is quite a good one, which is making sure that both parties are aligned on why they're doing this, in terms of both buyer and seller are aligned on what the reasons for why they want each other's partner. And I think actually it'd be not a bad thing to do, which is see if you can mutually agree a press release at the start of the process, and see if that works.
Thank you. Kathryn.
Oh, I can't do one, Mandy. I'll give a few. And it's all about the planning up front and getting that integration plan agreed, and get those recharges sorted, because they'll come back to haunt you if you don't. And at the end, I think integration is really fun. You need a lot of energy, a lot of passion, but it's the fun part of the process in my reading, because you've done all the hard work and negotiated the deal. Integration, the chance to meet people, get to know the company, and vice versa. So it should be fun, and you should celebrate the milestones as you go through integration.
For sure. Thank you. Dan?
I've got two, probably. Make sure the chemistry's right and you get on, because if you don't, it's going to be a very hard road. And probably make sure you both set aside the time to work through the real nitty-gritty detail of an earn-out, if there is one, because nothing's going to throw things off than people not understanding what deal they've signed up to, or not dealing with those issues in advance. So do that, put that effort in up front.
Fantastic. Well, that has brought us to the witching hour of 11. Thank you so much, Tim and Kathryn. That was absolutely fascinating for joining us and giving up your time. Dan, thank you as ever. Really interesting, and thank you very much to everybody who joined us. It was great that you found the time. I hope you found it useful. We've got a couple of questions we haven't answered. We'll have a look at those and see what we can do about those. Please do let us have the feedback. A recording will be available, and we very much hope to see you at the next one, and have a lovely rest of the day. Thank you.
Thank you.
Thank you.
Thanks. Bye.